Imagine waking up, checking your crypto app, and realizing the number on your screen is still there, but the money is gone. The token still shows a balance, the chart still moves, but withdrawals are temporarily paused, the website is slow, and the Discord is locked. In a few hours, your life savings have turned into pixels. No hackers, no dramatic heist, just silence. Now imagine this doesn't just happen to you, but to millions of people around the world at the same time. And instead of calling it theft, the headlines call it market volatility, a necessary cleansing, or a correction. That is the quiet horror behind a lot of modern crypto scams. They don't just take your money, they rewrite the story of how you lost it, so you end up blaming yourself. This is the simple economic blueprint, and today we're going to walk straight into the uncomfortable side of crypto that nobody wants to talk about. Not just the obvious frauds, but how these scams can turn into full-blown economic disasters. If you care about your money, markets, or just how the system around you really works, you'll want to stay with me to the very end, because the scariest part is not the scams you see coming, it's the ones that look like opportunity. And before we dive in, if you appreciate straight, no-hype breakdowns like this, hit like and subscribe right now so you don't miss the next deep dive. We're going to keep unpacking how money, risk, and incentives really work behind the scenes. All right, let's start with a simple question. How do intelligent, educated, skeptical people keep walking into crypto traps that wipe out billions of dollars in wealth, not just once, but over and over? It's easy to say they were greedy or they should have known better, but that explanation is lazy. The real story is more complicated, more human, and honestly, much more dangerous. To see it clearly, picture this: a young couple in their late 20s, finally making decent money, tired of watching prices for everything, rent, groceries, healthcare, climb faster than their paychecks. They're not trying to get rich overnight, they're just trying to catch up. They see videos of people turning a few $100s into a few thousand with some new coin or yield platform. Their bank offers them maybe 0.5% interest. A new crypto platform offers 20%. One looks safe but pointless. The other looks risky but hopeful. When the world feels like it's rigged, which one do you feel drawn to? This is the emotional entry point of so many crypto scams, and it's the first piece of economic reality we have to face. Scams don't work because people are dumb. They work because the official system feels broken. When people feel locked out of real wealth building, they go looking for shortcuts, and the people designing these scams know that better than anyone. Now, on the surface, a lot of crypto products sound impressive. Decentralized finance, yield farming, liquidity pools, algorithmic stablecoins, NFTs, tokenomics, fancy words, complex ideas, smart-sounding founders on podcasts. But underneath, the math often boils down to something a lot more basic. We need more new money coming in than old money going out, or the whole thing falls apart. In traditional Ponzi schemes, that pattern is obvious. In crypto, it can be hidden under code, jargon, and token prices that move too fast to question. Let's walk through one of the most common structures in a super simple way. Imagine I create a new token called Hypecoin. Total supply, 1 billion tokens. I keep a huge chunk for myself and the founding team, say 40%. Then I release a small amount to the public on an exchange, and I use marketing, influencers, and slick design to create a narrative. This is the future of finance. We have partnerships, we have a roadmap, we're early but growing fast. As more people buy, the price of that small circulating supply jumps. On paper, my 40% looks incredibly valuable. I haven't created real cash flows, real profits, or a real business. I've mostly created a belief system around a number on a screen. But here's the scary part. In the short run, that belief behaves like real value. People borrow against it. People spend based on it. Founders use it as collateral. It leaks into the real economy. That is the first way a crypto scam starts to become an economic problem. Fake wealth starts influencing real decisions. During bull runs, this feels amazing. People suddenly feel richer. They buy cars, move into bigger apartments, quit jobs, start businesses, and borrow more. Small countries even talk about Bitcoin cities and national crypto strategy. Local governments consider blockchain bonds and digital assets for their reserves. At this point, it's not just individual greed,
its policy, its culture, its national strategy. And while all this excitement builds, the core engine behind many of these schemes is brutally simple: keep the music playing.
To do that, platforms offer eye-popping yields, 20%, 50%, sometimes over 100% annual returns. Ask a basic question: where is this money actually coming from? And the answers usually fall into one of three buckets. One, they're paying you with fees from real economic activity, like trading or lending, which is rare and usually not enough to justify massive yields. Two, they're paying you with inflation of their own token, printing more of their coin and giving it to you as interest. You feel richer, they dilute the supply. Three, they're paying you with new customer deposits, just like a classic Ponzi. Often, it's some messy blend of all three. The hidden math is harsh. If the underlying activity isn't producing real value, then every yield is just a redistribution of someone else's principal. Someone is getting paid with someone else's savings. In a rising market, no one notices because price increases cover the holes. In a falling market, the holes become bottomless. Now, remember our couple. They put money into a platform promising 20% returns, marketed as safer than banks because it's decentralized, on-chain, transparent. The platform shows charts, audits, TV appearances, maybe even celebrity endorsements. It feels legitimate. It looks more innovative than a dusty old bank branch. For a while, it works. They deposit, watch their balance grow, tell friends, and even move more over. They feel smart, early, part of something big. But behind the scenes, the platform is doing something fragile. Maybe it's lending deposits to risky hedge funds. Maybe it's propping up the price of its own token to maintain confidence. Maybe it's taking concentrated bets on one stablecoin that isn't really stable. This is where we hit another uncomfortable economic truth. High yields often mean you've become the shock absorber for someone else's risk. The risk didn't disappear, it moved to you. In traditional finance, regulators, capital requirements, and boring rules try, imperfectly, to limit how much risk a bank or fund can take with your deposits. In parts of crypto, those guardrails are either weak or non-existent. So when something goes wrong, and something always goes wrong, the unwind is brutal. A stablecoin loses its peg, a big borrower defaults, a major exchange freezes withdrawals. The price of a major token collapses 50%, then 70%, then 90%. Suddenly, the platforms that looked invincible start posting long, vague messages. Due to extreme market conditions, we are pausing withdrawals. We are working tirelessly to restore operations. This is a temporary measure to protect our community. Translation: the money is not there. It has been lent, lost, locked, or leveraged in ways that cannot be unwound without admitting the system is insolvent. You are no longer an investor. You are an unsecured creditor in a slow-motion bank run with no insurance. Now multiply this not by one or two platforms, but by dozens, each with millions of users, each with connections to other funds, lenders, and exchanges. This is where the line between crypto problem and economic problem starts to blur. Because when those platforms go down, they don't just hurt speculators. They hit ordinary people, small businesses, even institutions that were chasing yield or trying to modernize their portfolios. When enough paper wealth evaporates, spending slows. Projects get canceled, startups die, jobs vanish. Governments collect fewer taxes. The crypto winter becomes a small macroeconomic chill. And the scariest part? It doesn't have to be a majority of the economy to matter. Look at housing in 2008. Not everyone bought toxic mortgages, but the crash in that one sector triggered a global crisis because it was deeply connected to the broader financial system. Crypto isn't that systemically central yet, but it has a similar pattern: leverage, interconnectedness, and opacity. A lot of value built on assumptions that only work in good weather. Let's unpack leverage for a second, in plain language. If you have $1,000 and you buy $1,000 of Bitcoin and Bitcoin drops 50%, you lose $500. Painful, but survivable. Now imagine you borrow another $1,000 at 10x leverage. Suddenly, small price moves get amplified. A 10% drop wipes you out. A 20% drop destroys not just your money, but also the lenders. Platforms loved leverage because it made trading exciting and fee-generating. Traders loved it because it turned small coins into lottery tickets. But economically, leverage is like adding gasoline to a campfire. It can create a big, bright, exciting flame. It can also burn down the forest. Now add in derivatives, perpetual swaps, options, leveraged tokens, beautiful tools in the hands of professionals, loaded weapons in the hands of everyone else. People weren't just betting on crypto prices, they were betting on bets on crypto prices. Each layer made the tower taller and more fragile. Then entry-level investors, like our couple, walked beneath that tower trusting that someone had made sure it wouldn't fall on them.
No one had. Let's also talk about one of the most powerful psychological engines behind these disasters: social proof. In normal life, if you see a line outside a restaurant, you assume the food is good. If your friends all use a certain app, you assume it's safe. In crypto, when prices are skyrocketing and everyone is talking about the same coins, platforms, or NFTs, that same mental shortcut kicks in. You think, if this was a scam, surely someone smarter would have noticed. But scams have evolved. The new version doesn't always look like a guy in a dark room hacking banks. It looks like venture capital firms, celebrities, sponsorships, stadium naming rights, and Super Bowl commercials. It looks like regulation discussions, global conferences, and friendly interviews on mainstream media. When big names back a project, it feels legitimate. Yet our second harsh economic reality is this: big money can be wrong too. And when it is, the fallout is even larger. Sometimes VCs and institutional investors chase hype. Sometimes they rely on the same flawed assumptions as retail investors, just with more zeros. Sometimes their business model even encourages quick flips: pump early, dump before the music stops, and leave the public holding the bag. In those cases, smart money isn't validating the product, it's just front-running the exit. Meanwhile, regulators struggle to keep up. Some try bans, some try light touch rules, some do nothing and hope the market self-corrects. But markets don't correct evenly. Power corrects, influence corrects. People closest to the exit correct first. Ordinary people, they correct last. By the time it's clear a scheme is dying, the insiders are gone. Which brings us to another subtle scam that's less discussed: narrative laundering. After a collapse, watch how quickly the story shifts. What was marketed as the future of money, a revolution, or too big to fail, suddenly becomes a learning experience, a necessary shakeout, or just one bad actor. Losses are reframed as risk you chose to take. Warnings that were ignored become obvious red flags. The system washes its hands even if many of the incentives that caused the disaster still remain. Here's the deeper economic danger. When enough people get burned badly enough, they don't just lose money, they lose trust in markets, in innovation, in institutions, sometimes even in each other. Trust is invisible, but it's one of the most valuable forms of capital any economy has. Without trust, people hold back, they don't invest, they don't spend, they don't start things, they hoard, they sit on the sidelines. And a society full of spectators is a society that grows slower, innovates less, and becomes more vulnerable to extreme ideas that promise simple fixes. Crypto scams don't just steal dollars, they can steal decades of financial confidence. Let's be fair though, not every crypto project is a scam. Blockchain as a technology has legitimate uses: transparent ledgers, programmable money, cheaper cross-border payments, new ways to represent ownership. But there's a crucial difference between technology and tokens. You can believe in the potential of decentralized systems while still recognizing that many coins, platforms, and opportunities built around them are at best hollow and at worst predatory. One of the cleanest questions you can ask of any crypto product is this: if the price stopped going up, would this still be useful to anyone? If the honest answer is no, if the entire appeal is number go up, you're probably not looking at an innovation, you're looking at a clever redistribution game. And when those games happen at large enough scale, in countries where people are desperate for stability, the damage becomes macro level. Think about emerging markets where local currencies are weak and people are searching for any store of value. Crypto projects flood in, promising protection against inflation, financial freedom, and access to global markets. But if those projects implode, they don't just set individuals back, they can worsen capital flight, deepen distrust in both local and foreign systems, and make future reforms much harder to sell.
Politicians then react, sometimes with total bans, sometimes with reckless adoption, sometimes with opportunistic corruption. Each swing creates more volatility, and more volatility tends to punish the poorest people most. Meanwhile, there's another layer no one likes to talk about: the shadow economy. Many legitimate-looking platforms quietly benefit from flows of illicit money, laundered funds, ransomware proceeds, tax evasion. Some don't ask too many questions about where deposits come from because volume is volume. When regulators eventually crack down, they often hit the whole ecosystem at once. Exchanges get shut off from banking, on-ramps and off-ramps tighten, even well-intentioned projects suddenly cannot operate. Again, the ones with liars and connections land softly, the regular users hit the wall. And those sudden squeezes can spill over into the real economy as people rush to fill holes created by vanished or frozen assets. Let's zoom back out to our couple one last time. They start in a world where their salary lags behind inflation. They reach for yield because they feel cornered, not greedy. They get pulled into a professionally marketed, socially approved, mathematically fragile system. They see number go up, they feel smarter, they start planning a better future. Then, in a matter of weeks, everything unravels. Not because they bought some random meme coin after 3 beers, but because platforms they trusted with huge teams, big backers, and shiny brands turned out to be leveraged sandcastles. After the collapse, they're left with 3 things: a hole in their net worth, a deep skepticism of anything innovative, and a quiet shame that makes them hesitate to talk about it. Multiply that by millions of people across countries, across classes. That's not just crypto drama. That's a slow, spread-out economic disaster, one that doesn't show up as a single 2008-style crash, but as a series of rolling personal recessions. Here's the uncomfortable twist. Many of the conditions that made these scams so successful still exist. Wages still lag, housing is still expensive, inflation still erodes savings, traditional finance still feels cold, slow, and rigged to many people. Tech is still worshipped. Attention is still weaponized by algorithms that reward hype, outrage, and FOMO over caution, nuance, and patience. So the real question isn't, will there be more crypto scams? There will. The real question is, will the next wave look the same, or will it evolve to feel even safer, even more legitimate, even closer to the core of the global economy? And when it does, will we recognize it in time? If you've watched this far, you're already ahead of the curve because you see that this isn't just about coins and charts, it's about incentives, human nature, and a financial system that leaves so many people hungry for shortcuts. If this breakdown from the simple economic blueprint gave you a clearer lens on what's really happening behind the screens, drop a comment below and tell me, do you think the next big economic disaster will come from crypto or from somewhere we're not even looking yet? And if there's someone in your life who's either all in on the next big thing or completely dismissive of it all, share this video with them and start the conversation. Thanks for watching. Stay skeptical but curious, and remember, in a world full of shiny new financial toys, the most powerful tool you have is still a simple question: where is the money actually coming from?